This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, April the 8th, 2015. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, the intermediate term risk, and the short term confidence and sentiment. This month, I'd like to cover a range of topics listed here, from what I see as a trifecta, and that is the integration of sentiment, productivity, and fundamentals and how they're coming together. And as I said here a second ago, we look at sentiment in the short term, we look at risk, and productivity changes are an element of risk in the intermediate, and fundamentals in the long term. But when they come together, you can get major and significant market shift, whether up or down. I want to talk about global slowing. We've continuously been talking about this for quite some time, but there are further developments. More recession signals that we're seeing. A black hole that may be appearing after the tax season of April 15th, IRA, RSP kinds of filings. And then what I'm seeing that is beginning to worry me in a number of areas highlighted here. During 2013, the Fed printed $1 trillion and the S&P index rose 30%. During 2014, the Fed printed $450 billion and the S&P rose 11%. Since 31st of October 2014, when QE3 ended, the S&P is flat. Worse still, it is vulnerable to a sharp correction given stretched valuations, a weak economy, and a contracting corporate earnings picture. Monetary tightening began with the end of QE3. What all of this has done is left us in what I will refer to as suspended animation. We all watched Wile E. Coyote as kids. We found him endlessly in suspended animation over the edge of a cliff, just before plummeting to his demise. That is about as good an analogy as I can give for the current situation in the financial markets. However, recall that Wiley always remained in this state much longer than we thought possible or reasonable before falling. He was in suspended animation. That is what a cartoonist can do, and appears to be what the central bankers can also do. I personally suspect the U.S. economy is going to keep moving towards recession, and thereby force the Fed to launch QE4. Now, they won't call it that, but it'll be an increase in the Fed's balance sheet. The financial markets have been carefully positioned for interest rate hikes, so QE4 would likely cause violent swings in the price of stocks, bonds, currencies, and commodities. The thing to keep in mind, however, is that the economy is not starting from an equilibrium position if they made these kinds of changes. We're already in a central bank liquidity-driven bubble. It was inflated to its current size by a 5-decade-long, 59-fold expansion of credit. Recently, credit is no longer growing rapidly enough to drive the economic growth, in my opinion. The reason credit can't expand fast enough is because households are overly indebted and wages aren't rising due to globalization. That means without additional stimulus, the global economies will deflate back into recession, and the U.S. is included. I can't see how the Fed will risk a recession for fear that a recession would turn into a depression. So I expect the Fed to launch QE4 later this year. Let me stress that, later this year. The impact on the markets of a QE4 decision would most likely result in the following. U.S. government bond yields falling further. The dollar would fall. The euro and yen would appreciate. Euro and Japanese stocks would suffer. Commodities would bounce, subject, of course, to supply and demand factors. Gold would likely rise. U.S. corporate profits would benefit, and U.S. and emerging stocks would outperform. Wells Fargo's Jim Paulson warns, I quote, "Never since 1900s have investors been this persistently bullish." He writes, and I quote again, "While the 13 previous cautionary signals since 1900 suggesting investor sentiment was too high have not been perfect, they have proved to be fairly good warning signs, and along with massive overvaluations and a dramatic decoupling of markets from economic productivity, this extreme sentiment reading completes the trifecta of flashing red warning signs for U.S. equity markets." End of quote. What we have, as he refers to, is strike one, massive overvaluation. Strike two, we have dramatic decoupling of markets from economic productivity. Strike three, we have near record extreme market sentiment. As illustrated here, the stock market has typically struggled once the R-squared on investor sentiment has risen above 90%, while Paulson's 13 previous cautionary signals since 1900 suggesting investor sentiment was too high, but not that perfect, they have proved to be fairly good warning signs. For 8 of the 13 signals, the stock market either immediately or fairly soon suffered a bear market, i.e. 1906, 1929, 1937, 1946, 1956, 1965, 1987, and 2007. Consistency. After both the 26 and 98 signals, the stock market eventually suffered a correction, and after both the 1952 and 94 signals, the stock market was essentially flat and volatile during the subsequent 2 years. Only the caution suggested by the 2003 signal proved inappropriate. Finally, the timing of a few signals were remarkably clairvoyant, i.e. September 1929 and September 1987 and December 2007, all probably the most serious corrections in that whole list. Since 1900, only when investors' sentiment was above 90% has the median 1-year forward percent change in the stock market been negative. The IMF is out warning of a slowing global growth and stagnation in its most recent World Economic Outlook. Analysts have been taking down global GDP for some time now, as we've talked about in previous videos. Even Goldman Sachs is very clear on the degree and seriousness of the global slowdown. Their analysis says the world is still in deceleration and contraction. World trade value in U.S. dollars shows the degree of collapse occurring. It is now near in comparison to the 2007-2008 crisis without anywhere near, in my opinion, fanfare. Of course, it was the same thing in 2007. Until the markets react, no one really pays attention, and anybody warning is just sort of poo-poo. It all makes this suspended animation occur, in fact. What some don't fully appreciate is that profits are measured in world trade values and not volumes. In this regard, the issue is very telling. We will come back to corporate profits here a little later. I mentioned last month that a scare to the market could come out of anywhere and take us out of this suspended animation. One shock that would not surprise me in the least is the possibility of a U.S. recession. Historically, we should be looking for one about now. I have shown this chart a number of times before, and we have since had further signs of this being a real possibility later in 2015. My macro analytics show co-host Charles Hugh Smith argues that and I quote, "the U.S. economy is slowing to stall speed, the point when gravity overcomes the lift provided by central bank treasury money. This deceleration is evident in a number of indicators such as gross domestic product, which is now at 0% according to the Federal Reserve Bank of Atlanta, well, at least 0.1. New orders for consumer goods have fallen off a cliff, eerily repeating the freefall of the Great Recession in 2008. Charles goes on to show here the per capita corporate profits, plus disposable personal income, plus government receipts and real final sales. Again, I quote him, "From the point when the growth rate decelerated below the stall speed of 1%, the average 4 and 6 quarter growth rates for real final sales per capita thereafter were negative 0.36% and negative 0.1% respectively, i.e. recession. Growth rates in both series have been deteriorating since the early 1980s when financialization began substituting leverage and debt for real growth in the real economy. Every dip below the zero line aligns with a recession. Once the lines dip below the 1% stall speed line, a negative growth rate follows." And I think I've shown chart previously that Richard Duncan has shown exactly this sort of thing in terms of credit growth. This second chart displays the credit market in a ratio with GDP, that is, minus government expenditures, leaving only the private sector economy, and real final sales, real meaning adjusted for inflation. Adjusted for GDP growth, the credit market growth has yet to reach pre-Great Recession levels. This reflects debt saturation. Adding debt no longer generates much expansion in the economy. The growth rate of real final sales has been declining since the early 1980s, with each peak and each trough being lower than the previous peaks and troughs. The growth rate in the current recovery has barely edged over the stall speed of 0% and is now rolling over. The primary inference is that the real after-tax income component of real GDP decelerated to stall speed, then a recessionary rate in Q3, Q4 2014. With the increase in the US dollar, net exports will be a drag, even with the collapse in oil imports as a result of the shale oil boom bubble. That leaves an expansion of the fiscal deficit, all else equal, to prevent recession or a contraction of nominal GDP with the marked deceleration of CPI and the GDP deflator. Because we don't have net savings, the Fed will have to resume printing bank reserves for the too big to exit, if I can say that, banks, to resume buying federal bond issuances, that is monetization, at some point later this year. This long-term weakening of the recovery is the direct result of financialization and the Federal Reserve policy of propping up impaired debt with more debt and constantly bringing demand forward with zero interest rates, or at least continuing to attempt to do that. Here is Richard Duncan's Macro Watch chart on annualized quarterly change in U.S. GDP. The trend is clear, as is the seriously low level of GDP we are currently experiencing. To make things worse, the most recent Atlanta Fed estimates have Q1 GDP at a meager 0.1%. It would appear things are getting worse fast in the world's only perceived near-term growth engine, the United States. This is why I see a 2015 recession scare as a real possibility. I mentioned world trade profit pressures. They clearly show in U.S. corporate profit trends. According to analysts, profits fell in 2014 and are again forecast to fall during Q1 and Q2 2015. I have written and discussed many times over the last 18 months the degree of market distortion that is occurring with 90% of S&P 500 profits being returned to shareholders as buybacks and dividends. IBM has been a blatant example of this, which I have previously shown charts on. But all good things do come to an end, though markets are likely to stay buoyant until all the IRA tax season contributions are made. There are some serious issues appearing under the market surface. The credit agencies have threatened to reduce IBM's credit rating if it keeps adding debt, which I have shown is being used to buy back shares, and thereby further deteriorate IBM's now precarious debt-to-equity ratio. IBM has more or less abruptly halted buybacks. Now we have Viacom revealing that as part of its, and I quote, strategic realignment to create efficiencies and drive long-term growth, end of quote, it would do something which the market loathes. It would stop its buybacks. Specifically, Viacom said, and I quote, Viacom will temporarily pause share purchases under its current $20 billion stock repurchase program in order to stay within its target leverage ratio. It makes me wonder if the credit agencies are now making a lot of unwanted visits to the S&P 500. Viacom's net debt ratio has likewise soared in the past several years and has reached a level where the Baa2 and the BBB rated company was on the verge of being cut to junk status. Here is a list of the largest S&P companies which have repurchased $2 billion or more in stock in the last 12 months and whose net debt to EBITDA is dangerously close to the fallen angel category. Not surprisingly, the top 20 results feature both IBM and Viacom. Expect many more companies in this visitation list from the rating agencies, especially those with higher net leverage. Expect them to likewise announce that their stock buybacks are also put on hiatus until further notice. This could potentially lead to a sudden and sharp air pocket in the stock price and the stock market. Additionally, not getting much attention is that decade-long surge in foreign currency reserves held by the world's central banks, which appears to be coming to an end. Global reserves declined to $11.6 trillion in March from a record $12.03 trillion in August, halting a five-fold increase that began in 2004, at least according to data compiled by Bloomberg. While the drop may be overstated because of the strengthening dollar reduced the value of other reserve currencies such as the euro, it still underlines a shift after central banks, with most of them located in developed nations like China and Russia, adding an average $824 billion to reserves each year over the past decade. Beyond being emblematic of the dollar's apparent return to its role as the world's undisputed dominant currency, the drop in reserves has several potential implications for global markets. It could make it harder for emerging market countries to boost their money supply and shore up faltering economic growth. It could add to declines in the euro, and it could dampen a demand for U.S. Treasury bonds. Notice what happened the last time this occurred, which I've highlighted here with the red circles. We have heard a lot lately about high yield in general and about the high yield energy space more specifically. Just recapping here, periods in quantitative easing in the U.S. saw the U.S. high-yield supply surge 50% above normal levels as issuers sought to take advantage of lower borrowing costs and investors clamored for the relatively higher yields they could get by taking on more credit risk. More recently, struggling oil producers have tapped the market in an effort to stave off insolvencies as crude prices have plummeted, leading directly to a situation where outstanding high-yield energy bonds account for a disproportionate share of all outstanding debt in the space. With rates set to rise later this year, with crude prices likely to stay depressed for the foreseeable future, and with suppressed liquidity in the secondary market for corporate credit poised to bring heightened volatility, the stage may be set for a potential high-yield meltdown. $91 billion in Q1 issuances is an example of the size we're talking about here. This would abruptly end our state of suspended animation, I suspect. Over the past several weeks, we have also seen quite a bit of discussion about the lack of liquidity in both corporate and government bond markets. In a nutshell, quantitative easing is taking its toll on Treasury and Japanese government bond markets, with both traders and officials in Japan voicing concerns about liquidity, while new regulations have made it more onerous for banks to hold inventories of corporate bonds, imperiling the secondary market at a time when new issuance is high thanks to a record low borrowing cost. Morgan Stanley are out with a new report that takes an in-depth look at the issue. From the note by Oliver Wyman on market conditions, and I quote, There's a liquidity conundrum in fixed income markets facing policymakers and investors. How it's resolved will have long-term investment implications across banks, asset managers, and the infrastructure players. At its heart is the huge shift in liquidity risks to the buy side and the asset owners as the twin forces of financial regulation and quantitative easing have played out. New rules have driven a severe reduction in sell-side balance sheet and banks' liquidity provisions. Wholesale banking balance sheets supporting traded markets have decreased by 40% in risk-weighted asset terms and 20% in total balance sheet since 2010. At the same time, credit markets have boomed as companies turn more to bond finance and investors are hungry for income. Credit market issuances is 2.4 times larger today than in 2005. As a result, daily redeemable funds have grown 10% per annum and are now 76% above 2008 levels. This comes at a time when Morgan Stanley thinks the liquidity of secondary fixed income markets is likely to get materially worse. As regulatory costs continue to drag on returns, Morgan Stanley expects another 10 to 15% shrinkage of fixed income balance sheet from the largest wholesale banks in the next 2 years. As much as 15 to 25% could be taken out of flow rates, or they think, given the huge return pressures on that market. Morgan Stanley also feels there is a growing urgency to tackle this debate by policymakers. The impact of less liquidity has been masked by a benign, ultra-low interest rate environment, but this is set to reverse in the U.S. in the next 12 months, potentially, and could also reveal the side effects of quantitative easing pushing investors into these less liquid securities. I believe the real deflation leg is underway. Though the U.S. equity market prices currently defy it in this state of suspended animation, the U.S. markets may stay elevated for a while, but like Wile E. Coyote, it defies gravity. When the Fed is forced into quantitative easing 4, we can expect real elevated inflation and the strong possibility of eventually seeing hyperinflation. Never forget, hyperinflation is a currency event which explodes prices higher as confidence in the currency is lost. It will be about lost confidence in the U.S. dollar, or possibly the replacement of the U.S. dollar as the dominant global currency in a de-dollarization event, which may be a result of last week's creation of the controversial Asian Infrastructure Investment Bank. Let me reiterate, I continue to fully expect a Minsky melt-up before all this ends very badly, likely in 2016. Eventually, it will be clear to all that the central bank policies have been a failure. The government's policy of financial repression is becoming way too heavy-handed as productivity falls, high-paying jobs disappear, and tapped-out consumer demand steadily slows and is eroded. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.